Hello and a very warm welcome. You're watching News 9. I'm Shweta Kothari. We're bringing you stories from the world of business, policy and economy. First up, let's begin with markets. To my left is Suyash Maheshwari. Suyash, a sea of red in the markets today, 0.5% down, both sensex and nifty.
Exactly, Shweta. Not a very good morning for the Indian markets. And, Indian markets opened in the red and they were down 0.5% on the back of mixed trend in global equities. Now, Sensex at open was down about 330 points of 0.5% or so, and it was below the 65,500 mark. Whereas Nifty was down about 106 points and it was below the 19,600 levels, which was seen as a very crucial support for the index, I mean, despite the fall, the overall breadth of the market was still favoring bulls. Around 1,300 shares were trading in the green this morning, whereas about only 926 shares were trading with declines, whereas 180 shares or so were trading, unchanged. The mid caps and the small caps on the other side is a completely different story. They were trading with moderate losses this morning, as you can see, but they have since recovered and they are trading flattish to positive. India VIX, Shweta, spiked up and it spiked up by about 7%. We, in the last few sessions, we have seen that the volatility has spiked up. First, it was because of the futures and options expiry. Now, it is because of the lack of cues, all of last week in the Indian markets, domestic cues were lacking for the Indian markets, whereas we were mostly reacting to, global headwinds about the crude oil, scaling a $97 barrel or $98 a barrel, the dollar index climbing to a year's high, and also the yields are, scaling a 16-year high. So after that, I think crude has cooled off significantly. I think it had corrected by about 2% or so last night, and
ending at about $92 a barrel, approximately.
Yeah. 92. So the last time I checked, Brent was around $90 mark, whereas WTI was hovering around $88 a barrel or so. And but the dollar index has continued to climb and it has scaled about 107 levels, which perhaps could be a dampener for the Indian markets. Now, talking about sectors, all the sectors barring FMCG were trading in the green. FMCG was flattish. It was up about 0.04% this morning. Whereas, among the laggards, Nifty Auto was the worst performing sector today. It was down about 0.9%. Other sectors, which were the major losers in the morning trade were pharma and metal. Now, remember, pharma and metal gained profits of about 2 to 2.5% in the Friday session. So perhaps you are seeing some sort of a profit booking taking place there. Both the indices were down about 0.8% or so this morning. Now, I think since the morning trade, the Nifty index has even broken down below the 19,500 mark, Shweta. It is down about 0.8%. And it is currently hovering around the 19,483 levels. Now, 19,500 was another level which the experts were saying will, provide support from here on, because if we saw the Nifty's rally from 19,250 to about 20,000, from 19,500 we saw a gap up opening. So there was a bit of void left over there where positions had not been set. So perhaps a break below 19,500 could drag the index, another 100 or 150 points. We'll get more cues from Mohit once he joins us.
Okay, I think he's here with us. Let's also quickly rope him in. Mohit Gang, co-founder and CEO of Moneyfront, with us this morning. Mohit, thank you so much for taking time out. It's going to be a shorter trading week. What's hurting the sentiments this morning? Is it global cues, or is it the upcoming MPC? What, according to you, are dampening sentiments?
Oh, hi. Morning, Shweta and Suyash. Look, I think honestly, for the whole of month of September, the global cues have not been very favorable, not just for India, but for the whole emerging market pack per se. I think dollar index rising, the US 10-year yield shooting past 4.68, which is a new high again out there. And the overall global macros not being extremely favorable is kind of hurting emerging markets, though we can always make a case for India and say we will be a little isolated this time around because of our robust fundamentals and robust domestic cues, but still it's just the entire house falling, so you can't be the left alone brick, right? So you will have to withstand that global pressure. I think the FII selling also after a long while in the month of September was negative. We had almost like 15,000 crores of outflow from the FII side, right? So it's getting tougher on the global macros, and that's what is hurting the markets. Domestically, we can always say that there's nothing much negative which is coming out. Crude, yeah, it's been around 95 plus kind of a level. It's again cooled down to around 90, 92 odd levels, which will remain a story which all of us will have to track very closely. Anything upwards of 95 or touching about hundreds is extremely negative for India. Even at 90 levels, we're not that comfortable, but yes, we can kind of sustain, right? So I think crude needs to cool down, and the global factors have to be a little more benign for us to now make the next move.
Now, Mohit, October generally has been a positive, historically speaking, has been a positive month for the market. Just want to get your outlook on the October series. Do you expect Nifty to, once again make a dash towards that 20,000 mark?
Suyesh, it's extremely difficult to call this one out because look, we have the impending MPC right now, and by all means, I think RBI should keep the rate intact, and that's very well factored in the markets. But the global cues, as I said, are not very benign and positive, and are not looking good for the entire emerging market pack per se until the results season surprises us dramatically on the upside, right? That could be the only trigger to my mind. But I really doubt that we can have a very big surprise coming out of the earning season this time. We will be mostly in line with the expectations, and few of the sectors might come a tad below the expectations also. So my sense is it'll be a wait and watch month. Will continue to hover around in this range. There's nothing very significant which can break the market down also, but positive triggers are hard to find by.
Now, Mohit, as you said, earning season is going to begin next month, and the first to come out with their report card, the Q2 report card, as always, will be the IT companies. Now, over the weekend there was a report from Nomura which said that IT sector could disappoint on both margin and revenue front, given the delayed client spending, especially in the small size and discretionary projects. Now, this is something that we've been hearing for at least the past few months. I just want to understand, in your view, what companies, I am talking about the large cap companies, who could post a better set of numbers from what the street is expecting, and who could play a dampener this earning season?
Look, Shwish, IT per se has been struggling for a while now. In the entire Nifty pack, I think IT has been relatively the worst performer. This thing, the large cap IT pack, the mid cap ITs have been soaring, and they've been doing relatively quite good and fantastically well. But the large cap pack, especially the big three and the big four names, they've not been able to outdo the expectations of the street. And I continue to believe that that pressure might sustain for a quarter or so, till such time that we see US and the larger economies stabilizing, and perhaps a bigger indication of the rate cycle reversing. We will see the IT pack continue to struggle. But the moment we have an inkling of the rate cycle reversing on the global front, which is the US Fed starting to reduce rates, that's when we can have a positive trigger on the IT pack per se. But I continue to see that the larger IT names will be under some pressure to give a positive guidance from here on.
Now, Mohit, JSW Infra's listing was today, and it has listed in fact at a premium of about 20%, which is pretty much in line with what the market was expecting. Now, given the current price at which, I mean, the stock, the price band at the upper end of the price band of about 119, it was, the valuations seemed fairly reasonable at about 29 price to earnings, compared to Adani Port's 33 or 34 price to earnings. Now, at current juncture, what would be your advice to investors who are allotted shares? Should they book listing gains, move out the stock, keep holding it? And also for the new investors, can they get into the stock at this point in time, or should they wait for some correction?
Shuyash, again, we don't have a very large coverage out here. Just from my little bit of reading on this one, I can say that, look, honestly, I think the stock is up somewhere around 25 to 30 odd percent in this trade today itself, right? And that's a good listing. The entire pack is buzzing with order books flush for every second player in this pack, whether it be infrastructure, whether it be construction, whether it be real estate, whether it be electricity, transmission, ancillaries, all these kind of sectors are actually buzzing and hot right now. For a new investor to come in and get into in any of these sectors, not just this name, I think will be a very tricky call right now, honestly, given the valuations and given that these valuations are solely based on some order books, right? We don't even know the execution capability. We don't even know how those things will pan out for next 1 or 2 years, and we don't know how the macros will shape up. So my sense is it's a wait and watch scenario right now for the new investors to come in. For the existing ones, if they have a fairly long term horizon of around 5 years and above, then perhaps yes, it's a hold. But for someone who's looking at a good, neat, handsome 25 to 30% on gain, I think it's not bad to take it off the table.
Now, Mohit, I also wanted to get your view on the paint stocks. You know, a lot of them have come under pressure. Including the likes of Berger Paints and Asian Paints. Now, one of the reasons why the stocks were trending downwards was the spike that we saw in crude prices, which was threatening to break past the $100 mark. Another reason was the potential entry of the JSW group and the confirmed entry of Grasim, which is expected to enter the business by the fourth quarter of FY24. And from reports, it seems that it is aiming for the second spot. So in light of all the, the movement that we are seeing, once the dust settles, who do you think, will emerge the contender for the top spot, and also what will be your preferred pick in the sector?
Well, look, Shwesh, out here the call is extremely clear. The market leader is a leader by a fair bit of margin, right? So Asian Paints has been leading the pack for a while, and in terms of the quality of management, in terms of the way they have adopted to technology, the way they have ventured into new segments, and the overall longevity of the business and the brand value. Honestly, I think it's a long way up for other players to catch up with them. Berger is a close second. For the new entrants, it's a very highly competitive market. It's not just the organized branded market, but the unorganized market across the India is extremely fierce and competitive. There are a number of local regional players basically whom you have to contend with. My sense is it will take a while for the new players to establish themselves, and I continue to see that the top two in the market will continue to remain in the leadership position for a long while to come. I think the festive season is around the corner. We should see some good demand uptick, the kind of consumption driven stories which we are seeing right now, and the kind of demand which we are seeing. I think that's fairly robust, right? The Indian household is out there to spend, and my sense is these stocks, because of their valuations, perhaps are seeing a kind of dull period. But on a fairly long term outlook, these are very good positive stocks to hold in one's long term portfolio.
Okay, also want to get your view on the consumer durable pack, especially the electronic consumer durable pack. Now, they have witnessed a sharp valuation correction in the past, 1.5 to 2 years due to weak earnings, which was primarily due to technology driven valuation erosion. Now, with the, as you were saying, with the festive season and the wedding season coming up along with the the kind of rebound that we are seeing in the housing sector, what's your overall outlook in the of the electronic consumer durable sector, and what will be your preferred pick among the likes of Havells, Orient Electric, Crompton, V-Guard?
So we've seen a massive run up, right? So we have seen a massive run up in Havells and Polycab, right? Those are stocks for last 2 3 years. They've given tremendous returns, and people who have been invested in this, I think they've reaped the larger part of the benefit. My sense is the cream is off the table, and now one has to be a patient investor for one to reap rewards. However, I continue to believe these are all very small sized companies, right? There's no large cap or mega cap in this segment in India as of now, and there are a lot of new players who are entering it. We just recently saw the listing of RR Cable, which again is a very dominant player in some markets, and has an extremely strong fundamentally driven balance sheet, right? So there are a number of smaller players. I would look for us to significantly up the bat on this one. You have to really back the leader, and it's not very clear as of now who the leader will be in next 2 3 4 years. My sense is smaller bets spread across these 5 6 or 4 5 good quality names, and then one has to wait and watch as to who turns the table around and becomes the bigger name out of the entire pack, and one has to keep backing that bigger name to capture a larger share of organized market, right? And you are seeing the transformation in the country where the inorganic market is moving towards organic branded players across all these segments, whether be furniture, whether be lighting, whether be the tiles, the granites, the electrical equipments, anything and everything which you see, the market is moving towards organized branded players, and lot of unorganized share is being captured by these players. So one has to wait and watch as to which stock really turns the story around and becomes a large cap. In India, we still have a long way to go for these kind of stocks, but I think, yeah, these are all very positive stories to capture.
Okay, all right. Let's also quickly take a look at stocks that we are tracking this morning.
Yes, Shweta. So let's start with Vedanta first. Now, on Friday, the company announced the demerger of its businesses into 6 listed entities, which will be Vedanta Aluminium, Vedanta Oil and Gas, Vedanta Power, Vedanta Steel and Ferrous Metals, Vedanta Base Metals, and Vedanta Limited. Now, Vedanta said that it's going to be a vertical split, meaning that all these companies will become standalone business and a pure play business, and every shareholder of Vedanta will also get 1 share of each of these 5 listed new entities. Now the stock, Shweta, as we saw, on Friday ran up about 7% or so. Today also it's up about 2.5%. Although on a year-to-date basis, the stock has been an immense value destructor for its investors. It's down about 27%
Absolutely.
or so. So,
Mohit, let's quickly get in Mohit to before we move on to other stocks. Mohit, a sharp volatility we've seen in Vedanta stock over the past 1 week. It's been in the news one way or the other. How is the demerger likely to impact the stock performance, and will it now finally start adding value to investors?
Exactly, because Vedanta share promoters are saying that it will unlock value for the shareholders. We just want to understand how, given that it has such big debt on its books right now.
So look, Shweta and Suyash, I have a very core belief in stock markets that you need not be tracking and investing in every sector and every company. And few of the stocks, the stories are so muzzled up and the stories are so complex that one has to be really deep into it or has to avoid it. And I think Vedanta is one of those stories. Honestly, I shudder to enter into this territory where I can't understand the real intentions of the management, and the real path forward also is very hazy to me. It might sound very good that they have done a vertical split across their businesses, empowered each business unit, 5 different verticals, will unlocking value, and all is very fine. But look at the history of the company, look at the history of the management for last 3, 5, 10 years. It's honestly, to the retail shareholder, I don't think so they have really made enough money or they have given enough on the table ever, right? So the promoters raised stake 2 years back, then declared a huge dividend and then reduced their stake, and now they're demerging the company, right? So anyone who was entering the stock by virtue of a high dividend yield for last 2 years, I think that story is over. Will the business units fetch independent value, and could few of the businesses be hived off to pay the debt? I think only time will tell. Even the restructuring story will take almost like 12 to 18 months to actually fructify. If at all it fructifies, there are a lot of approvals required and a lot of things required. Out of the entire pack, I think Vedanta Aluminium is one company which still has a lot of value out there because of a lot of backward integration in the entire chain. But again, as I said, you need not be invested into every stock, and it's virtually humanly impossible to track every sector in the market. This is one sector and one stock where I will always keep, which I will always keep away from.
Now, to Mohit's point, Shweta, there is a little, some news or reports that, Vedanta could perhaps look at selling some of its assets or some of its businesses, in an effort to pay back the loan. And, the $2 billion payment that is coming up by the end of FY24 will be a big problem. I think from reports they suggest that at least analysts are expecting that as far as the this payment that is coming up in FY24 end of 2 billion, it will be covered by the fundraising activities and that Vedanta has overtaken in the last few months. However, it will still need to sell some of its businesses, probably to perhaps pay off some of the debt, which has been a big concern for the company. And Mohit, I also want to talk about Hindustan Zinc. Now there is also news that Vedanta could be looking to restructure Hindustan Zinc and list the silver business separately, the zinc and the lead business separately, and the recycling business separately. Now, I mean, Hindustan Zinc is a fully integrated company where we are seeing that, I mean, zinc, lead and silver are a byproduct of zinc, and you know, hiving off the businesses separately will, I mean, lead to a rise of related party transactions. So what is the thinking over there? Why are they, you know, splitting up Hindustan Zinc, which seems to be a fully integrated business, has been a cash cow for the company?
Suyash, look, as I told you, it's extremely difficult to actually figure out what the real intentions of the management are behind all this restructuring. It sounds good on the face of it, that value is being unlocked and businesses will independently be assessed in the public scrutiny. However, I see there is more behind the curtains out here, and we will only come to know of it in next 12 to 15 months. It's not just the debt which is maturing in FY24, but in FY25 itself, they have almost another 2 to 3 billion odd which is maturing. So the total debt which is maturing over next 2-3 years is upwards of 4 billion, right? So which is a massive number, and it all goes to show that how the whether this restructuring will actually help the company to pay off those debts. I honestly don't know. Right? Management has to come out and give us a path that how the entire debt will be paid out and how this restructuring will actually be fructified and be useful for a few of these companies. As you rightly said, Hindustan Zinc, it's very difficult to figure out what these entire three businesses will do separately, right? So again, as I said, it's not important in stock markets to be everywhere and in every stock.
Also tracking auto numbers for the month of September. Major auto companies like Maruti are in the news.
Yes, so Maruti, you know, their half yearly sales have surpassed the 1 million mark for the very first time. Although, I mean, on month basis, the growth has been rather muted. I think it has logged a growth of about 3 to 4%. Now, the stock was trading down the last time I checked this morning. Another reason why the stock perhaps is under pressure is because CLSA over the weekend, you know, retained its sell rating, although it has revised the target price upwards to around 9,400, but it still implies a downside of about 11% from, you know, Friday's closing. Now, the reason why CLSA has a bearish outlook on the stock is because, you know, even though FY24 was a very good year for Maruti, when FY25 kicks in, it does not have too many launches coming up. I think Maruti only has just one SUV in the pipeline, whereas Tata Motors and Mahindra & Mahindra have 4 or 5 vehicles in the pipeline. Mm-hmm. And I mean, if we look at the returns of Maruti Suzuki touched a 52-week high last week, so perhaps there is some profit booking taking place. In the course of 6 months, the stock has run up about 25%. Mohit, how are you, I mean, judging the stock on the price charts right now? Is it a hold, buy or a sell?
Is fully priced in at these levels. Honestly, I think market was expecting better numbers in terms of the auto sales being reported. The numbers are a little muted in comparison to the expectations of the market. However, yes, they have touched a new record of over 1 million units for the half year for the first time. But overall, Maruti is losing in the premium segment. Maruti is losing its share in the EV segment. So there are a lot of pockets to be for it to catch up, right? And I think it's also been losing the market share of late. So my sense is it's an uphill task to maintain that market share for Maruti. It's been a market leader for a while, and market leader always has a tough job on the hand when the competition is so fierce across diverse players and new launches are rampant. As you rightly said, Maruti doesn't seem to have anything up its sleeves as of now, which can really entice the market or tempt the market. Only thing which is yet to be seen is the festive season, which has kicked off, and for next 2-3 months, I think how the demand will come through and what are the number of sales and everything will be keenly watched by the market. But as of now, I think the stock is fully priced in at these levels.
I also want to get your view on the two-wheeler pack. Now, you know, TVS Motors and Hero MotoCorp have run up significantly. Even in the September the monthly sales report card, I think they have outperformed the market, whereas iShares sales have shown a degrowth of about 4% or so. So, the entire sector is shifting towards premiumization. So, who do you think will benefit from that shift? And I mean, if one were to invest in a stock of a two-wheeler company, which one would it be according to you?
Look, Suyash, I think Hero MotoCorp has its own struggles to deal with. They command almost 44% market share, and the market share has been declining. They've declined. It's almost declined by 3 to 4% in last 1 year odd, right? Their newest launch, Charisma, is yet to pick up. I think what they've announced is a price hike of around 1% odd across all their brands. And I think Charisma will also see a price hike of around 7 to 8,000 rupees effective today. So my sense is, let's see if how does that entire thing pans out. But I think they are struggling to retain their market share, and they're also struggling to enter the premium segment, which is extremely well captured by Eicher Motors. Right. So Eicher Motors, I think, has been a dominant player for a while, and continues to be one power to reckon with on the premium segment. And the motorbike market in India is moving gradually towards that premium segment. Right. The lower end segment is more moving towards those EV two-wheelers, the autos, and I think out there the likes of Bajaj Auto are the ones who are really gaining market share, and are the ones who are is one stock where I'm keenly watching the growth trajectory. I think that's one which stands out of the entire pack.
All right, Mohit, thank you so much for taking time out. Appreciate you joining us this Tuesday morning. We'll keep coming back to you too, Suyash. Thank you for the lowdown of markets. But as we continue to track numbers that are coming out from the month of September, another number which was very interesting at it has come in the form of GST. GST has crossed the 1,65,000 crore rupee mark. My colleague Karthik Malhotra walking into the studio to give a lowdown of what the numbers are looking like. And it's a brilliant number. Over 1 lakh crore is what the government has been targeting consistently, and it has come in at that.
Much higher than that, Shweta. Hi, good morning to you. I think 1.6 lakh crore has pretty much become the average of GST collection on a monthly basis. Now, if you look at data of the last 6 months, we've just completed H1, April to September. If you look at the last 6 months, 4 out of these 6 months have actually seen a GST collection number over 1.6 lakh crore rupees. And the latest data coming in for September stacked up beautifully at 1.62 lakh crores. Now, where are the leaders and where are the laggards? I think it's important to understand that. Before we get into that, I think a bit of context. You've seen inflation reaching 7% and higher numbers. It settled down to about 6.8% or so, but if you average it out for the April to September quarter, a 7% inflation would result in any goods and services you purchase on an average being about 7% more expensive. That means 7% more tax collection for the government is by default a direct impact of inflation.
Okay.
Now, if you look at a year-to-year basis, September last year versus September this year, GST collection has gone up about 10%. So if you were to discard the 7% inflation adjustment, then the actual increase is just about 3%, 3.5% or so, depending on how you calculate it. Now, okay, nothing to complain about it. I think overall GST collection going up is an indication of a robust economy, is an indication of consumption picking up. Now, juxtapose this with other data. For example, car sales. Maruti alone touching 1 million cars sold. Look at other data that we've been, touching upon almost on a daily basis. Cash transaction is down. But at the same time, you have seen this growth in retail loans. You've seen people living off credit, which means overall the consumption story is robust, and that is clearly reflecting in the GST data as well. Now, who are the leaders, who are the laggards? I think it's important to note that Maharashtra, the state of Maharashtra, has contributed to the highest GST collection at about 25,000 crore rupees. Now, next in line stacks up Karnataka, followed by Gujarat and Tamil Nadu, all in the range of about 10,000 to 11,000 crore rupees. Haryana and Uttar Pradesh come next, a little short of 10,000 crore rupees. Haryana at about 8,000 crore rupees, Uttar Pradesh at about 7,000 crore or so. Now, interestingly, you've seen degrowth of GST collection happening in a state like Bihar.
Okay.
Bihar has degrown about 5% on a year-to-year basis.
What does that tell us?
So it tells us that perhaps, you know, the consumption story is not looking too good in a state like Bihar right now. In fact, even the CAST survey released just yesterday, it shows that about 80% of Bihar's population, 85% or so, is in the SC, ST, OBC bracket. But if you leave that aside, I think what the story really tells you on GST collection is that the industrial states are raking up the numbers. You look at Tamil Nadu, you look at Gujarat, you look at Maharashtra, you look at Haryana, Uttar Pradesh, Karnataka. These are your top industrial states which are contributing in good measure to GST collection. So GST collection, it seems from the data, is happening more on the back of manufacturing, more on the back of goods and services being produced, and not as much when it comes specifically to a consumption linked story. Okay. But overall, the numbers, I think, are adding up well, and it indicates that there is a buoyancy in tax collection overall for the country.
And there's buoyancy. It's good news for the government, at least more money in government's coffers. It's a very crucial year. We keep discussing right ahead of the election season. But it's not just GST, it's also the securities transaction tax, which is likely to surpass budget estimate.
That's right, Shweta. So budget 2023, this year, 1st February, Finance Minister Nirmala Sitharaman had raised the target of security transaction tax, STT collection, by about 10.5% or so to 27,000 crore rupees. From data which is emerging right now, at least in the first half of the year, it seems we are well ahead of that target. Now, security transaction tax ranges between 0.025% to 0.125%, depending on whether you're buying, you're selling, future options, spot trading, etc. So STT collection for the first half of the year, again adding up well above that 10.5% target, and it seems that the budgetary estimate of about 27,000 crore rupees should easily get surpassed.
All right, and it is expected. We are adding new investors each passing
Absolutely.
day. In fact,
That's
the story that we discussed on
that's
Friday.
The beauty. If you look at all the data emerging from everywhere, it's all adding up to this buoyancy, which is good news. You're seeing manufacturing activity pick up, reflected in the CPI numbers, right? You see that that overall there is more consumption happening by account of new houses being purchased, by new cars being purchased, and more number of investors getting added into the securities market. So, overall, I think when you look at it, you look at the EPFO data, employment getting added, right? And now we are heading into festive season. So all this consumption is likely to only, grow even higher in the next 2 months of October and November. Overall, the picture is looking good.
And people are also investing. They're also spending, which it essentially means that there is more discretionary money in the hands of people.
If not only discretionary money available, I think there is the surety of continued income coming in.
Right.
So you don't want to really save for the rainy day because you don't see a rainy day on the anvil.
Okay.
You believe that yes, employment numbers are good. You will be able to jump from one job to another. There is easy access to loans. Even though they are expensive because we are in a high interest rate cycle right now.
Right.
But you know that loan is available. You don't really want to save up. You don't want to keep money in the bank, which is not even going to beat inflation, and hence adding to the overall consumption story in the country.
All right, and all of that looking good. But what's also surprising in all of this is, and maybe not so surprising, with 2,000 rupee note out of circulation for the very first time, currency in circulation has declined in the first half of the year.
That's right. So currency circulation is almost at a decadal low. If you were to eliminate,
a 10-year low,
if you were to eliminate the the note ban demonetization period of a few months in 2016, overall at a decadal level, currency in circulation (CIC) is at an all-time low. Now, what does this indicate? Number one, it indicates that overall, from about 33.78 lakh crore rupees in circulation, which is 33.7 trillion rupees in circulation at the end of last financial year, 31st March 2023, till 22nd of September this year, this solid 6-month period, you've seen about 77,000 crore rupees eliminated from circulation. Now, a lot of this is attributed to the 2,000 rupee note that got withdrawn.
The last date for which, by the way, has now been extended.
Absolutely, right. Not surprising because 24,000 crore rupees was still in circulation.
Yes.
So, but I think what it also means is that the RBI has collected about 3.46 trillion rupees, 3.46 lakh crore rupees. But overall cash in circulation has reduced in the 6-month period from about 33.77 lakh crore rupees to about 33.01 lakh crore rupees, which means only 77 lakh crore rupees or so have actually been withdrawn, while the RBI has collected about what, 4 times, 5 times that money, which means that while the 2000 rupee notes have been withdrawn from circulation, fresh currency of about 2.6 lakh crore rupees has been printed and brought back into circulation. Right. Whether printed or previously printed currency brought into circulation. But overall, I think the story of GST also ties in with the fact that 77,000 crore rupees worth of transactions which could have happened in cash have not happened in cash, and these have happened in other means of payment which are easily taxed, easily traced, which could be UPI, which could be cards, which could be net banking, etc. So about 77,000 crore rupees worth of cash transactions, cash in circulation reduced, despite 5 times that amount of money collected by RBI by way of the 2000 rupee notes withdrawn.
So should we then read too much into this data? Could it just go back up in the second half of the year?
I mean, it's difficult to say with the penetration of UPI, with the ease of payments today available, with, with people like me also ditching the wallet. I don't really carry a wallet anytime I go out. I carry my phone. But I think overall, you see ATM activity has reduced. Number of ATMs that you find across streets, in busy markets have reduced. This is, I don't have empirical data. I'm just giving anecdotal data.
Absolutely.
It suggests
a daily experience of dealing with cash.
It suggests that your regular transactions that you would withdraw cash for and transact in cash have reduced, at least in the middle income group, in the salaried employees, in those who don't have black money or don't really transact as an SME, you don't really deal with cash. So overall, you see that this cash transaction, cash activity has reduced. Now, will it come up? Is there an incentive for this to come up? I think the only incentive is if you don't want your transactions to be monitored, if you don't want to pay tax on it. But overall, you look at GST compliance, you look at income tax data, there is greater compliance. And I think there is this genuine movement towards people adopting, low cash transactions and registered, traceable transactions overall in the economy.
All right. So people are going increasingly cashless. At least that's what the data is suggesting for the first half of this financial year. Another story that we discussed at the start of the bulletin is with respect to auto numbers in the month of September. Since we're talking numbers are looking very good for most of auto companies as far as the month of September is concerned. It looks like festivities finally kicked in.
So, Shweta, I think it's difficult right now to ascertain whether festivities have kicked in or not, because on a sequential basis, the growth hasn't been great. On a
yearly
Y-on-Y basis, the number is good. So look at the headlines which are emerging. I think
let's begin with Maruti.
Yeah, number one, Maruti Suzuki, right? India's largest automaker, largest four-wheel consumer vehicle maker in the country. 1 million number in sales in the first half of the year. I mean, I remember 2021, 2022, we were looking at a total 2 million car sales in the whole year. Here
for all auto companies.
All auto companies. Here you're looking at one single auto company, the largest, no doubt, achieving a 1 million number within the first 6 months. So, number one, yes, Maruti Suzuki has been able to launch new models after a fairly long hiatus. It has cars like Grand Vitara, it has cars like Fronx, Baleno, etc., which are selling like hotcakes, right? Even the much awaited Jimny has made its final entry into India. So, on one level, new model launches, a hybrid approach with the Grand Vitara, and overall both domestic consumption as well as export adding up to about 1 million vehicles sold is a great number. Contrast this with what is happening, let's say, with Tata Motors. Tata Motors, I think the headline emerging there is that even though the numbers are small, the rise in the electric vehicle category is as high as 57% year on year. So that becomes a solid headline, I think, to lead with, because you have 57% more, almost 6 in a 10 number of people more buying electric cars than petrol or diesel cars. And that, I think, is the real story, that while you see Tata Motors really basking in the glory of electric vehicles, the sales of its traditional bread and butter diesel vehicles has reduced. Now,
passenger vehicles overall has reduced by about 3%. Commercial vehicles is up, which is again a very interesting trend.
I know,
Come
true,
to think of it.
I'm talking primarily, I think what interests our consumers right now is passenger vehicles alone, cars that you buy and cars that you drive.
Right.
So electric vehicles surpassing on a percentage basis diesel vehicles. Diesel has been the mainstay of Tata Motors. Now look at what Tata Motors is doing in the UK. It is actually shoring up battery manufacturing plants in the UK, creating employment there. It has committed that by the turn of the decade, in fact even earlier, 2027, 2028, the entire JLR fleet is going to be electric. Now what does this do to, let's say, somebody like a Mahindra and Mahindra, which has its feet firmly placed in the diesel market? I think a quick rethink, early launches of electric vehicles is something that Mahindra and Mahindra must do. Add to that what Maruti is doing. Maruti has been a laggard in the SUV business. It continues to be a laggard even in the electric vehicle business. The first electric vehicle from Maruti Suzuki is likely to hit the markets not before 2025. So this means that there is a shoring up of EV sales, there is a ditching of diesel vehicles, and there is overall this focus on how efficient your vehicles are going to be. I don't think people are looking at it as much from an environment sustainability standpoint as sustainability on the wallet. For Delhi NCR, for example, you won't have to ditch your electric vehicle after 15 years, like you do your petrol vehicle or your diesel vehicle after 10 years. So electric vehicles become a long-term stay for consumers like you and me. And add to that the charging infrastructure, the highways, the road connectivity, etc., electric highways coming up. The EV story is where I think the focus of the entire auto sector will have to pivot to in the coming quarters.
All right, EV story playing up in a big way. At least that's what sales numbers are suggesting. A 57% rise in the lineup for EV cars as far as Tata Motors is concerned. But shifting to a story related to auto, but very important from a customer point of view, which is the safety of these cars. The Bharat NCAP has finally kicked off from 1st of October. What does it mean for safety of cars for people like us, perhaps, and an average consumer who looks at the safety ratings before actually wanting to buy a car?
So what it means is, Shweta, pretty clearly when you draw those multiple filters of which car to buy, safety should be up there. Right.
Absolutely.
Is it or is it not? I don't know, because, you know, being a very, very price sensitive market.
Actually, it is. I mean, it's very surprising this morning. I was reading Tata Nexon, which got a 5-star rating from Global NCAP, has crossed 500,000
is also one of the top selling cars.
Absolutely, and one of the top selling cars in its segment.
True, absolutely. But is safety the only reason why people
Maybe
bought
not.
it? You don't know, right? Because
Right.
it is a well-priced mini
Absolutely.
SUV, compact SUV. It also comes in an electric version, right? And overall, you see people driving that car. How many of them have looked at the Global NCAP rating? I don't know. But because we are a price-sensitive market,
I mean, we'll all look at those crash tests, you know, out of curiosity
these are great visuals, right? You see this beautiful testing lab, and you have a car coming in high speed,
crashing,
and what happens to it?
and
Will
which
it crumble?
survives?
Will the airbags inflate? And what's going to really happen? I mean, great visuals. But I think being a price-sensitive market, again, I keep coming back to that. I think first you will look at how much is that car going to cost you? How many seats does it offer? What is your requirement? How much is it going to cost? What is the mileage it's going to give you? Kitna deti hai, I think, has been a maxim for Indians for the longest time. But add to that, now I think this great move by the government, number one, to have compulsory airbags in every car, seat belts being mandated on highways even for the back seats. So overall, there is this ABS being a default option pretty much in every car, the anti-skid braking system. Add to that now the Bharat NCAP, which becomes a global standard equivalent for cars being made in India and being sold in India. I think it's a great measure for people to understand that in the eventuality of a crash, are you likely to survive? And what are your possibilities as compared to any other cars which you want to buy, which are in your consideration set? So I think it does become a feather in the cap, at least for companies which have a good crash test rating. But the only problem with Bharat NCAP, despite it, it's voluntary, right? So I don't think it is mandated, and there isn't a timeline given for this to become mandatory. But I think it is going to be a case in point to note that more and more cars willing to even volunteer their vehicles, their models into this crash testing and some sort of a rating emerging from there means at least those cars are safe to drive.
Okay.
So if nothing else, if you have two cars in your consideration set, one which has undergone the voluntary testing and has a high star rating, something in excess of about 4 stars or so, should become a preferred option in the same price band, in the same mileage band, in the same number of seats, etc., in the same similar look and feel of the car. As compared to a car which does not undergo a crash testing. So I think if nothing else, it's a nudge. It will act as a pressure, peer pressure for other models of cars which are not undergoing the crash test to make those cars available for crash testing.
Hopefully it adds some peer pressure. I mean, that's the big hope, of course, because all of this is voluntary, but Bharat NCAP kicks in from 1st of October. Will this happen in India, the crash testing? Crash worthiness?
I believe so, yes, absolutely. I think the crash testing, maybe not immediately, maybe they're using facilities outside, but it doesn't make sense to export models after models of cars just to crash them and get them back. I think there should be some crash testing happening in India.
All right, lovely. So crash testing all set to kickstart for those companies and those automakers who volunteer to do so from 1st of October. The Bharat NCAP has finally kicked in. But with that, we've run out of time on this bulletin. Thank you very much for watching.
He thought he could outlast us. And 1 year later, the evidence is right here in this room.
Who will blink first?
So far from preventing the expansion of NATO, Russian